Alright, let's get it started. 24th of February, Tuesday, and we're using a first presented Velric from 6 days ago. Still potent, still beautifully delivering. Thank you, Kevin, for putting this one out. Don't know if it's in here yet, but one is Zach. How are we doing? If we go to yesterday's price action as well, it was being used very heavily. I didn't see it because I wasn't using that in the stream. Good morning, Ailey. I've got pre-market low. Looks likely. Now I got a pre-market high. As always. Clean this up. Nice run lower so far. Began in the 950, well, the 850, 910 macro. Pretty much a controlled demolition. Looking for these lows, the 8 AM opening range gap lows. Those ones. But anyway, let's go to the bias. Okay, so if you were looking at the daily analysis or my Twitter, you'll see I am looking for the previous day low. So I'm looking at sell day. For the daily chart, 4 hours, kind of indecisive right now, but I think we'll probably give up here and go lower. Hourly range, my hope is that we just trade to the pre-market low and run it, go into the intraday low and then the previous day low, which is this level. Bit of a consolidation morning. Asia didn't do much. Well, it expanded, but it's not huge in the narrative right now because London didn't react to the inefficiencies like you normally may expect it to do. Like, because normally if Asia expands, I'd want to see it trade down into Asia expansion for value gap and then continue or reverse. But it was indecisive, and then the whole pre-market's been purge and revert type environment, which I like, but it's just kind of leaving me in a bit more of an indecisive spot going into the morning session. So the pre-market range and the opening range gap are going to be what I primarily use to gauge the narrative and order flow. We've just got a couple reference points here with the 15-minute fair value gap, the 18th February's AM first presented fair value gap, pre-market high and low, NWOG, London low, should mark that out as well because that's a very important liquidity pool. And we'll use the opening range gap on this right side of the chart. Morning. User, I don't know what to call you because your name on YouTube is just user. So that's kind of confusing. Like the stream to my 7 viewers. Wonder when these streams will stop popping off. Looking for a first presented gap. The 9 AM first presented fair value gap. That's the 8 AM first presented fair value gap. missed my take profit by one tick. Brilliant. And that's 7 o'clock, 1% of fair value gap. Really nice pre-market range today. Really, really nice. Did you watch ICT's live last night? I caught the last like 20 minutes. To be honest, I didn't watch it back today because I didn't really want to. I will watch it soon. I have 2 more to catch up on, and then I'll be on this most recent one. I was going to say something and I forgot. 10 a.m. news. So it's consumer confidence. Let me just bring it up. It's medium impact, but sometimes it can be a nice volatility inducer at 10 o'clock. Okay. So consumer confidence, 10 a.m. Orange shoulders, not what everyone would consider high impact, but it's a nice. Sometimes it can be a bit of a candle, like a bit of a large candle, but it's not something to worry about. It's just sometimes it can stall out the couple minutes before 10 o'clock, and then at 10 o'clock, it's a nice little run. 9 p.m. President Trump, pedophile Trump is speaking. Don't really know, don't really care what he's going to say, but what's up, Kevin? It's a wild card, so I mean, it's not like we really need to worry about it because I don't think anyone trades at the time, anyways. But don't trade Asia, basically. Okay, that's the 8 a.m. opening range gap lows taken. Not opening range gap, sorry. Opening range lows. Because we're going to gap higher on the regular trading house chart, I want to see us trade down into consequent encroachment. And hopefully even get a gap closure, 782. But it's going to be a small opening range gap by the looks of it, because we're already in closing on that price. 30-40-ish handles. Potential for a black bell. Seems like anytime there's a black bell, it's going against my bias. I'm wrong and the black bell's right. It's kind of hard to hold a bias in these horrible, horrible price conditions for the last however many months this is. It's not brilliant, is it? But it's navigatable. Like, we called most of these candles, even in this range bound condition, we've called a lot of the run lower. And this week's been a bit rocky so far. Okay, not a large opening range gap then. Just gonna be like 20 handles or something. Make it red. Make it dark blue. Okay, I don't need all the quadrant levels that I may usually use because it's only small, so I'll just use the consequent encroachment. It's already reached consequent encroachment. It's taken the pre-market low, so that's our bias. Well, that's one side of the range patched. This is a black bell by the looks of it. Depends if it's going to be a sweep. It looks like it's going to be a sweep, and if it is, that would stimulate a nice bullish black bell. But if it's a run, then London low. Just depends. Okay. Bit of an indecisive candle, wicks on both sides, so still waiting. Please no black doing things to okay. Let's be cordial. Okay, if this becomes an inversion for value gap and it's a run to the pre-market low, that supports the previous day low getting traded into so nicely. So I would prefer that, to be honest. That would like fulfill my morning bias a lot easier. And yeah, it's running through the pre-market low. That's good, because that means no black bell. It's also swept the PM session relative regular trading hours buy sell liquidity, an immediate rejection of it, so that's also good. Crosses through the NWOG, so it doesn't cross to the London low, but it crosses through the NWOG with a nice displacement candle. This SIBI is, well, it's not a SIBI yet actually, so wait. I'm hoping it's a nice SIBI because it's overlaying the NWOG, and it would also be a first presented for value gap. So it would just be a really good SIBI, a really good array. Okay, no around. That is first P, bearish order block. Also, I'm using these older regular trading hour gap levels. So that's I'll brighten this one up because it's pretty much the only thing we have to work with. Today's ones suck. This is Friday's opening range gap, the green ones. The purple is today's. So small that it's pretty much irrelevant. That's beautiful. Beautiful. I think we all know where it's going next. On the regular trading hours chart, we have that PM session sell side, and on the electronic trading hours chart, it's also a draw. Plus, it's unswept on the electronic trading hours. It doesn't really matter if it is swept. It doesn't reduce the strength of it on regular trading hours, but it's nice that both charts are aligned and saying the same thing, because that's typically where you'll see the one-sided expansions. Hi Dream Forex. Hi Nehemiah. Nehemiah, congratulations on getting funded. Do I hear first presented fair value gap? I think I do. Do I or no? I do. Okay, that'll do for me. First presented. Itchy. What's up, Abdullah? This is the daily charts of volume imbalance, so you'll need settlement toggled on to get the exact levels that I'm using. Otherwise, you'll see it a little bit differently. So this is settlement toggled off, settlement toggled on. That's all the changes. Okay, the first presented fair value gap is also overlaying Friday's opening range gap lower quadrant, so this should be a stronger array. Supercharged, as ICT would say. I think that goes in by just one tick. Yeah, it does. 747. One tick into that gap. 931. Sorry, 931. What about 931? How's yes doing? Same story here. Never complaining. First presented fair value gap. This wouldn't be a first presented fair value gap because it's so small. So although that is an inefficiency technically, it's like, what is that, 2.25 handles. This is called a common gap, so we wouldn't use this as a first presented fair value gap because it's not significant displacement, whereas this one is a significant displacement. So this is the one that we use, and this one we can pretty much ignore. Okay, again, bearish order block. Everyone's having fun reading this price action, I know it, because it's so easy. Bummer that in micro didn't go into that gap. Oh. Even if you had your limit there on the mini, it might not have filled you because of spread. Sub lumbar. Yeah, we're just looking for previous day low. It's delivering perfectly right now. I don't like these wicks though. Back into the first Prezi. How do you know it won't just turn on a dime before previous day low? It could, because it has taken out a lot of sell side, but I think it's strong enough of a draw that it can take that out. Hopefully I'm not wrong. Yeah, to say Zach. Trying to get this to show that though. Okay, it's gone completely against that. Inverted that first Prezi. That's taken out this low. That's price range. Crosses through the analog. And there's low resistance liquidity around here with a pre-market high. That's unswept. Da, da, da. Yeah, looks like it's just flipped direction. Doesn't want the previous day though. That's sad. Took out the internal range of that PM session. PM session sell side internal range lows. Took those out, but didn't want the rest, it seems. Okay. Oh, such an ugly 15-minute candle. Because I was looking for this to become an inversion fair value gap, and it's not an inversion fair value gap until it can close below it. But even if it closes below it, like, I wouldn't consider it an inversion unless it goes beyond this NWOG high because of the long wick. Right now, I would say it's got all this low resistance liquidity here, and it's above 930 opening price. Where's 930? It could retrace a little bit below it, but it's so strong. It left such a strong big gap there that I don't think it will. It'll just rip through the low resistance liquidity here and go into the pre-market high, it seems. These are our first presented fair value gaps from the pre-market session. No, I don't need to extend them actually. Beautiful, bullish, absolutely. Close my classic sell day, nice. You know what'll happen, look at YM. I don't like YM. Don't ever talk about YM to me. I'm joking. YM, I don't use it that much for... I can use it for a little bit of strength divergence, but I'm not using it for... Like, if it's out of sync, I don't care. Because a lot of the times it'll be out of sync doing the complete opposite of NQ and ES, and these two assets will still divert beautifully. Okay, this is where you want to read the order flow inside of this fair value gap, first presented from the 18th of February, because you want to look at the quadrant levels. So I want to see if I find support of this lower quadrant. I've talked about this in the past, where the staircasing effect. You just want to see a staircase off of the quadrant levels. Displacement through is even better, but as long as you're seeing the evidence of smart money accumulation, like right there, that's immediate rebalance. It just traded down, tagged that. Did it tag that wick? Fell ever so slightly short of that wick. That's an immediate rebalance in my book, and rejects. We're in that 7 o'clock first presented fair value gap, so you want to see the levels inside of this. That dotted line. Body is on it. If we can see it run up above that, that'd be beautiful. I use it for a continuous trend, like this case. Fair enough. That's actually a good use case for it. I'm not gonna lie. Okay, if it doesn't run off of the consequent encroachment on this fair value gap, then it just means it'll probably stick around for a bit longer, accumulate, and then run up. But if it goes, then it goes. I'll add a border on these. Oh, bullish volume bounce. That's pretty nice. Is that the final high? Yes. So all of this trend line, retail trend line silliness, liquidity's been taken. The final objective would be the pre-market high. It's so strong that it'll probably rip above the pre-market high. But this is what you pay yourself. There you go. Objectives above this is 19th February's NDOG NWOG, but I wouldn't use the NWOG. I would use Event Horizon. Should be that level. If I was targeting it, which I'm not. Let's project the breakaway gap. Okay, sure. Why not? I mean, it's pretty difficult to project because it's so big. This is encompassing like 20% of the range by itself. Let's just do that. 960. is consequent encroachment of this previous day first presented by Arlinger. That would be random. I don't mind budget as well because in chat. Good, Kevin. I don't want to see you here for the rest of the stream. Doesn't sell from pre-market. Proof state low was my draw on liquidity. Thought you would get a first one. Yes, I got some profit. In that situation, I think you did good, Atlas, to be honest. Alright, bye, Ataku. Yeah, sometimes they just won't go to the draw and there'll be an S&T. You say ES took the previous day low? Oh yeah, it did. Brilliant. ES took it and Q didn't. I mean, in that situation, there's nothing really you can do. You can either get out early, anticipating that the S&T will deliver, but I probably wouldn't have because it was pretty strong going lower. And you just get stopped out in profit. That's business costs. So I think you did very good. I had this narrative where you look at the markets before open. Today we had smooth highs. The sell side was jagged a little bit, expecting the high to be taken from a lower. Okay. Call that short. P went pretty stable on ES as well. Nice. Took a loss trading to previous day low and one when entering as it retraced into 8:30 open to pre-market high, breaking today down. Well done, Zach. Yeah, unlucky. It's better to if you don't know how much. Yeah, because it had the London low and then it also went into the daily volume bounce. The body stayed above it and the wicks went in. I should have probably observed that a little bit better. But that's okay. Okay, that's your breakaway gap projection. Delivered. Remember, this is never a draw on liquidity, it's just an estimation on how far we can trade based on the magnitude and the level that the breakaway gap forms inside of a price run. So from that low, measuring the consequent encroachment of the breakaway gap, you can also measure the high with 0.25, 0.2. In extreme scenarios, I wouldn't do it here like that, but in this case that makes no sense. You just use this, and that is your breakaway gap distribution expectation. Well, no, this would be breakaway gap implied dealing, and then the standard deviations would be distribution expectations, but in this situation it's perfectly fine to just use the implied range high because how large the gap is. It also aligns perfectly with previous day first presented fair value gap consequent encroachment. But still, pretty much every fair value gap in this run is still unfilled. 1 unfilled, 2 unfilled, 3 unfilled. Not even traded into. I see a man. So for the breakaway gap projection, you hit 25% on consequent encroachment. Breakaway gap, also this liquidity wick. Can I use the whole void? If it's a liquidity void, I've never done it with liquidity voids to be honest, so I can't really speak to that. That's interesting though. I should probably look into it, but I've never done that, so I can't really attest to it. Yeah, you use 25% on consequent encroachment, or you go 20% on the low or the high, depending on your expectation on the move. So if you're expecting it to really, really deliver, then you could use 20% on the breakaway gap high. If we do that here, whoops, wrong asset. Here, the breakaway gap is so large that when we go from the breakaway gap and I put 30% on the higher the breakaway gap, it really, really skews up this range. And I don't know if it can trade that high. So you just look at it and eyeball it and think, that's completely unrealistic, I'll use the other level. That makes more sense. And there you go. So a bit of context to it. It isn't a drawn liquidity. It's just a protraction calculator. You could use standard deviations on gaps down. Let's watch this for sure. Yeah, you can use standard deviation. It's not really standard deviations on the gap. It's measuring measuring how far the range should go based on a breakaway gap being there, and then where in the range that breakaway gap forms. Because we know a breakaway gap should form at 20 to 30%. Well, in the initial third of the run or higher, the breakaway gap should be there. So if we know that, anywhere that you measure technically from the lower third, if the breakaway gap is in there, and you project it with 2/3 further, then you're getting the high of that range of what it's expected to be. And then you can go with standard deviations if you're expecting it to keep running further and further. It's long-winded, it's not necessary, it's just a way you can calculate stuff. It's not necessarily functional. If you're a beginner student, don't even worry about that. Infinitely dropping stuff, thank you. Yeah, always. We're in the 950 10-10 macro right now, so because we had such a strong run on the open, we're bound for some consolidation, but it's okay. We'll just chill. It's a long move. It's a long move. In a long move like that, for example, would I re-enter for a buy? Or would you re-enter? Because it's breakaway gaps the entire way through, you have to do the breakaway gap drill. So the breakaway gap drill, I explained this before, but it's just when the fair value gap forms, if you're seeing something like that, you know it probably isn't very likely to deliver back into that gap. So you can enter on the candle where the fair value gap is created. So when this candle closes, you could enter there. You could enter on this candle's close, half of the position size, and then the other half would be as a limit order at the breakaway gap opening price. But you have to also calculate the risk to reward ratio because the first entry won't be the ideal entry because you're entering on the candle's closing price because you don't want to miss the move, but you know, because you're entering on the breakaway gaps closing candle, it is more likely to run higher, faster, but you're also at a less favorable price. So it's a trade-off, and sometimes better to just not be involved. Trump speaking at 9 o'clock today. His tariffs just got what was it? The Supreme Court ruled them illegal or something. So he'll have a lot to say at 9 o'clock today. So it'll be a volatile market for sure. I mean, at the moment it is, but later in the day they may just generate sentiment. But it's at 9 p.m. after today closes during the Asian kill zone. So I don't think it'll be a hindrance till today. Maybe the last hour will be a bit slow. See, every level on this chart is providing information. Every single one. London low swept trades into the daily chart volume bounce. Wicks I could put eighths on here. Yeah, Wicks the eighth. Eight. Wicks the eighth. The upper eighth. But I'm not going to use eighths. Bodies close outside of the first presented, of the daily volume balance. Change to delivery. breakaway gap through the first presented fair value gap, inverts that, crosses above the N log again, crosses above the 15-minute fair value gap again, through the 8 o'clock first presented, breakaway gap, retraces inside of the 7 o'clock first presented fair value gap, runs to these relative equal highs and the pre-market high. These highs were held down by the 18th of February's AM first presented fair value gap, runs into the 19th of February's N dog, perfectly, probably random, goes into the breakaway gap projection high, only goes a little bit above it by like 3 handles. Previous day first presented fair value gap consequent encroachment, goes above it by like 2 handles. I mean, that's precision that an EMA can't give you, that trend line can't give you, the RSI can't give you. And remember when it just laid the body on the consequent encroachment there and then ran? That was nice. What PDOs do I always have on the chart? Usually. So I always have a couple N-dogs and N-wogs. So you see these orange lines, or the purple lines. Those are new day opening gaps or new week opening gaps. I always have, I probably have quite a lot. I removed quite a lot of them from my object tree, but I've got a bunch that I've not even got told on. Then I also have first presented fair value gap of the session. Sometimes I'll have some old ones, like that's yesterday's first presented fair value gap. That's the first presented fair value gap from the 18th, which was like Thursday or something. No, Tuesday, I think. Sometimes I carry on forward from the pre-market range, but not always. Today was a really beautiful displacement pattern of that pre-market, so I opted to use it. What else do I use? High time frame PD arrays, like high time frame order blocks, breaker blocks, wicks. I use gray pools. I love gray pools. From a high time frame, you bring a gray pool down to a low time frame. It's just beautiful. I use volume balances and immediate rebalance for pyramid entries. I use propulsion blocks for pyramid entries. I use order blocks and gaps and mitigation blocks and breakers just as order flow reading tools. So I'm not always using them for entries. Like, I don't use a mitigation block for an entry that much, but I can use it for a draw, or I can use it for reading order flow. Yeah, loads. But if I had to bring it down to the main one, like my favorite one, I'd say the NWOBs and NDOGs. If I had to only limit myself to one PD array, it would either be NDOGs or inefficiencies. How do you create the object tree? So when you click on your drawing tool, so if I click this, first presented fair value gap, you have to name it, otherwise it won't show up on your object tree as anything. So if I name this example 1, go into object tree, find example 1, where is it? Okay, you have to click enter as well. Forgot to click enter. Here it is, example 1. I click this on, click it off. Very nice. Possibility for still a bullet. Can I dump it again? I would probably assume yes until the 9:30 open. Go into the breakaway gap and the N-log, but that's not a bias because it's already delivered both ways. I would love, absolutely love if they just, oops, if they just ripped it down again into the previous day low. That'd be so nice. I'm not expecting it, but if they did. take some levels off now. First printed BPR 955. Well, technically it would be this one. Ooh, just tapped it one more time. That first printed fair value gap. Yeah, first printed BPR is a bit more of a. I mean, if you think fair value gaps are subjective, bounce price ranges are so subjective. Because I can see it completely differently to you. There's different types of bounce price ranges. Some of them are like really objective, but if you are to strip the market into its two components, it's just bounced ranges and unbounced ranges. And obviously this run higher, that's unbounced. But from where we're narrow, right here, this little V, this is all a bounce price range. All of it. But I see it like this, but you might see it as this whole run here is a bounce price range. So all of that technically is a bounce price range. And then it gets unbalanced because it's a one-sided move. And then you could say this is also a bounce price range. But if you get too deep into that, you're just going to confuse yourself, and trust me, it's not a fruitful rabbit hole. And it is useful to know, but it's not always. I don't think a newer trader should even look into that. 24,580, you think? 24,580. Sam, you always go for the crazy ambitious targets. What's even at 24,580? Or are you just using institutional figures? Yeah, I think that fair value gap's going to deliver as well. But I don't think it'll take it down to 24,580. 260 handles away. So I'm looking at it in a step-by-step way. So I'm looking at the opening price first, then the inefficiency, then this low, then the previous day low, then the staircasing on the volume bounce, start to look at consequent encroachment, then the regular trading hours end up, then maybe the low on the volume bounce. That's how I would look at it. Let's grade this range. Ooh, did reach a discount, didn't sustain it for very long. Then it went to this. Give it a couple more candles. That's a result of not sustaining the discount price. If it can't spend a lot of time in discount, what's that telling you? It's sensitive to that level and it's bullish. But if it lingers there, or if it displaces through it, it'll be the opposite. It's an intermediate term high. See if it wants that or not. If it doesn't, that tells us a lot. So hungry. Okay, it hasn't taken the intermediate term high. Sign of weakness, but not enough of a rejection, because as it went lower, the wick closed back in, and it stayed inside of these PD arrays, so not ideal. But I want to see the body leave it, and then one-sidedly deliver, but because that's not happening, back to neutral. Take a look at the regular trading hours for a moment. That's a Friday opening range gap high. It's the upper quadrant, fails to reach into it. So this is when I talk about reading order flow with the quadrant levels. It's ICT's teachings, but I'm talking about it. It trades up through it, displaces through lower quadrant, displaces through consequent encroachment, displaces through upper quadrant. A little bit of a feather on the opening range gap high. And as it trades down into it, it's rejecting consequent or upper quadrant, fails to even reach into it. That's bullish, just like a fair value gap. If a fair value gap has failed to trade into, that's even stronger. And you're seeing a series of higher highs, of higher lows. Low, next one is higher, next one's higher, next one's higher. It's the first sign of bullish order flow around the quadrant levels. Even better when the wicks are going in, the bodies are closing out. That doesn't happen on these two, but it happens on these. You'll see a little miniature bullish volume bounce right there. Now, I'm not saying it's going to run higher or lower, because weird spot at the moment. I want to be bearish, because my daily bias is for the previous day low, and I don't think it's invalidated yet. I think we could still see that today, but it would require a lot of weakness right now, or during lunch, maybe. There's that 15-minute London fair value gap. Such a long wick, and then it just leaves it alone. 1 minute inversion for value gap. Fails to trade down into this. Uses the suspension blocks. Set at midpoint. No. They don't want anyone to short. I don't know. $9.30 inverted order block. Yeah. The high of that as well. Wait a minute. Wait a minute. You're telling me that the high on this consequent encroachment, you can also see the grey pool. Stopped price to the tick. What is it, 1 tick? The low on that is A19.5. This is A19. Yeah, 1 tick away. That's random. Random price delivery. We're seeing increasingly that the move just happens at the open and then it just stalls the rest of the session. I remember back, I'd say 2024, I wouldn't even trade the open. I would just look at the first 30 minutes. I would trade after the opening range. I wouldn't even look at the open. I wouldn't even sit on my computer for the open. And now, if you're not at the computer for the open, you've missed it. Like there's nothing else for you to do. Well, you missed the big move. You can still get little cookie cutters in this, but the higher probability move would be this. That's only 2 years ago. It's like the market shifted 30 minutes forward. It's funny. ICT said 24-hour trading would be even easier because there would be no new day opening gaps and runs would just be quick and speedy, which is interesting because I thought it would be harder, but he says the flow, like the continuity on the price runs, they wouldn't be disturbed and the gap risk would be a lot lower. So if gap risk wasn't there at the new day open, I would feel so much safer trying to trade overnight for holding for multiple days because I can do classic buy and sell days because there's no limit opens that are affecting me. But if I was to do a one shot, one kill, I wouldn't be able to sleep because I don't know how much it's going to gap. It could gap one handle, it could gap 100 handles. It's very weird nowadays, but with the elimination of the new day opening gap, unfortunately, I do really like this PDRA. But when they transition into 24/7 trading, it won't exist technically. I think though, even when they transition into 24/7 trading, if you use the same reference points of a new day opening at 4:59 and 6 o'clock, you'll still see like the algorithm price delivery. Maybe even better because then it will be hidden from everyone. Just like regular trading hours, we use reference points 4:14, 9:30. But anyway, ICT says that with 24/7 trading, there'd be no gap risk, or a lot less gap risk, and I was like, oh, I could finally start trading one shot, 1 kill again. I like that it flattened out at the consequent encroachment level. Just eyeballed it. But if you look at this, grade the wick, it's in the civvy, reaches into the consequent encroachment, flattens out at the consequent encroachment of the 18th of February's gap. A high frequency trading algorithm could do something like this. A high frequency trading algorithm. Not a real trader, I would never do this, but if I was like a high frequency algorithm, I could see like a signature like that. I could take a trade like that. And I'd have like 500 of those trades across one session. It would stop me out, but it's 500 trades, that would be a little bit of profit for a high frequency algorithm. A high frequency algorithm is such like a poor way to trade. I don't even like know why people want to program those. It's so much more effective when you can just catch a move like this, in my opinion. 500, yeah. Because it would be like on the 5-second chart, 1-second chart. Yeah, exactly. Okay, we're back and forth here, and we might start delivering, but it's time for me to end the stream. I gotta do a couple things, and then I'm gonna open my fast, and I'm starving, so I can't continue. But if you came and you started the stream, thank you. I'll see you tomorrow for another one. Goodbye.